Imagine waking up to news of a looming recession. Your investments, your job even, is hanging in the balance. And it's something that happens cyclically. We know a recession will eventually happen sooner or later because it's happened that way again and again in the past. But what if I told you the groundwork for the next economic downturn has already been laid, and that the COVID-19 pandemic and the onslaught of government intervention did nothing more than just hit the snooze button? Well, that seems to be the reality, and it seems like, in my mind, there are 3 scenarios that could unfold that could kick us into a recession if they're not handled correctly.
If you are watching us from the last home you'll ever own tonight, consider yourself lucky.
The plunge was sparked by a jump in US inflation. It was enough to force the Dow Jones down 616 points.
Enthusiastic crowds at the job fair, people looking for a chance to make that good first impression.
By the closing bell, the Dow Jones Industrial Average was in the steepest fall in its 103-year history, down more than 500 points.
Scenario 1 is the interest rate tightrope. Essentially how central banks and governments have been playing with the interest rate to make sure that we don't dive into recession and keep the inflation from getting out of hand. And given how high inflation is, they've been doing a poor job of it. But all of this is essentially a knock-on effect from the COVID-19 pandemic. Imagine this. Interest rates, the cost of borrowing money, have been climbing, as they have. But the guys in charge at the central bank are now hitting the pause button, which they kind of already have. Prices stop rising as fast as before, which is inflation slowing down, but the cost of services like haircuts or restaurants, for example, will remain stubbornly high. They're not going to lower the price there. The breakdown of this is that central banks raised the rates to slow down how fast prices were increasing, but this has the knock-on effect of borrowing getting pricier even for the normal consumer like you and me, which meant that loans for things like houses, cars, or businesses cost more. That meant that a lot of people would have to cut back on spending, and that has the knock-on effect on the economy. So I give you that quick breakdown just in case you're not up on all this stuff to kind of understand that increasing or decreasing these interest rates is a tightrope because it has a big knock-on effect down the chain. It's not as simple as interest rates just affect people who buy houses or when you're going to buy a car. It has a big knock-on effect throughout the economy. And during the pandemic, central banks lowered the interest rates massively to stimulate business at a time when people were trying to save as much as possible in a big time of uncertainty for everybody. This cheap borrowing encouraged everyone to spend and invest as much as possible, which was great at the time, but also planted the seeds for prices to massively rise afterwards, which has happened. So now, even though prices aren't going up as fast because the pause on the interest rate in this scenario has intervened, it means that while the prices aren't going up, the cost of borrowing is still quite high, and that will affect businesses, people from buying houses. That will cause people to likely save more instead of spend. And that means that we could end up in a recession because while people aren't spending and investing, the job sector isn't growing, the economy isn't growing, and that is literally what causes a recession. The GDP not growing for 2 quarters in a row is generally the definition of a recession, even though it was changed during the pandemic. So the question is, how long in this scenario can governments continue to play this balancing act? I don't think it's further than 2026 personally, but that's just me. The second scenario is a huge one. Remember the dot-com bubble or the 2008 housing crash? Of course you do. Well, imagine something similar, but maybe less dramatic. A significant market adjustment rather than an outright downturn. Here's what's cooking. Sky-high asset prices. So things like stocks and real estate are priced really high at the moment compared to where they were in the past. This again is a kickoff from the pandemic. Investors feel invincible because prices are super optimistic and keep pouring money into investments. And this means companies are then under pressure because businesses might struggle to deliver the big profits that everyone is expecting. Market adjustments then happen, which happen because companies disappoint, investors might start selling, and this causes prices to drop. Feeling less wealthy as investments go down, people might spend less money. During the pandemic, governments pumped a ton of money into the economy to keep things afloat, With interest rates low, a lot of cash ended up in the stock market and other investments, think GameStop for example, and this pushed stock prices up. While this made people feel richer on paper, the underlying value wasn't there. And this means that we could see a big downward adjustment kick in soon, and that could be something like 87, probably not anything like the big crash at 29, but if you look at Black Monday in 87, it could easily end us there. The dot-com bubble is another example of that. We've had this massive bull market because of a huge investment through COVID, which all really happened on paper. And then there's scenario 3, which is the supply chain squeeze. Remember how hard it was to find certain things during the pandemic? Well, while things have gotten better, there are still major cracks in the economy and in the supply chain. Global tensions have been rising massively, as you may be aware. Arguments and conflicts between countries mess up international partnerships. This causes fragile supply chains because important materials and products sometimes run short. That means costs in these supply chains continue to go up as companies have to pay more to get the raw materials and stuff they need. Prices increase because businesses have to pass those prices on to you. And then as things get more expensive, people eventually start paying and buying less, which can slow down the economy. COVID-19 showed us just how delicate our global supply chains are. And even though we've made progress, things like computer chip shortages and shipping delays still cause headaches. And tensions in the Middle East, as well as tensions between Russia, China, and the West over Ukraine and NATO, all of these things could end up putting a strain on the entire supply chain once again. And unlike COVID, this could be a long game that could cause huge hikes for us and even have a knock-on effect on scenario 1 of the interest rate tightrope that I talked about earlier. The pandemic didn't just turn lives upside down. It also changed how the global economy works in ways that we're still kind of figuring out. Some of those are huge government spending. And here's how it may have pushed back a recession rather than stopped one. Because remember, in 2019 and leading into 2020, economists were talking about how a recession was very much on the cards in the next couple of years. But huge government spending, governments all over the world spending tons and tons of money to support people and businesses, that could have a knock-on effect down the line. This cash injection kept companies running and people in their jobs, but it could have just paused things. Super low interest rates that were pushed throughout the pandemic will also play a huge part because even though they kept the economy going, they have increased the debt throughout the world massively as people took on more and more cheap loans, which maybe they can't afford in an economic downturn. And changes in how we spend also will factor in here. With lockdowns, people bought more stuff, gadgets, goods, instead of services like traveling and dining out. And this helped some industries, but threw a lot of other things off balance. The simple fact is people talk about more money being there, but realistically there wasn't more money. There was just money being spent in different places. And here's the catch. These measures might have just postponed problems rather than solved them, as I said. Governments can't keep spending like that forever because the debt increases. And as the support continues to wind down, the economy has to stand on its own 2 feet. So are we heading towards a massive recession? Well, look, in all of these scenarios, the steps taken during the pandemic are a common thread. The massive spending and low interest rates were needed at the time, but might have just set us up for future challenges. As I've said, we've got lots of debt, overpriced markets, and fragile systems. So the likelihood is that this has just kicked the can down the road, and I think we're looking and staring at a recession, personally, for 2026. What can we do about it? Well, the first thing is to stay in the loop. That, of course, means subscribing. But mixing up your investments could also be a really good idea, and making sure that no more than 20% at most of your portfolio is in any one marketplace. Mixing this around means that you'll be least affected if one market crashes, and even though you will be affected if the entire thing falls like a house of cards,
If we can hit that bullseye, the rest of the dominoes will fall like a house of cards. Checkmate.
on a table that has turned, checkmate, you'll be in the best position to survive it through a diversified portfolio. And saving for a rainy day is a really good thing to do starting now, because if you are saving, not only Are you preparing yourself for a poor situation? You're also best preparing yourself to invest when prices drop, which is where you should be buying. And pay down any high interest debt you have first. Look, it's not all bad news. Recessions make more millionaires than any other time in history, but making sure you're prepared now is the key. When prices drop, there are market opportunities, boosts in innovation, and positive changes as governments try and figure things out. So is the next recession on the way? Yes, frankly, it is, because there's always a recession on the way. The question is, how far out is it going to be, and how willing and capable are governments to intervene? But it is best to start preparing now, because the recession could come sooner than you expect. Subscribe.